Good morning and welcome. And I have the distinct honor of introducing our first keynote and speaker today. Blair Hull is the chairman of Hull Investments, founder of Ketchum Trading, and former CEO and chair of the Hull Trading Company. Blair Hull founded Hull Trading Company in Chicago in 1985, a firm that grew to be one of the world's premier market-making firms. Hull Trading was an organization built on outstanding thinkers in the field of investing, science, and mathematics. By embracing both efficiency and innovation, Hull Trading grew to be one of the country's largest and most profitable independent trading firms. His multidisciplinary approach combined trading expertise with state-of-the-art technology and quantitative modeling. Hull's process used computerized trading to capture thousands of short-term stock and options misprices each day, while continually calculating portfolio-wide risk on a real-time basis. The success of Hull Trading Company strategy led to its acquisition in 1999 by Goldman Sachs. Today, Blair Hull oversees Ketchum Trading, a privately held proprietary firm located in Chicago, Illinois, that he founded in 2010. It is driven by algorithms and technology. His high-frequency trading firm makes markets and trades in futures, options, and ETFs. Mr. Hull has served on the board of directors for the Chicago Board of Options Exchange from 1988 to 1990, and the Board of Options Clearing Corp. from 1992 to 1998, and the Board of BARA from 1992 to 2004. Today, he's offered to share with us his perspective on how technology has changed and is changing the trading landscape. Please help me welcome Mr. Blair Hull to the stage.
Thank you. It's a great honor to be here. I'm just, in the time that I was at breakfast, I met about 4 friends that I've known for a long time, some of the great innovators in the field of finance, including Norman Packard, who I haven't seen in 15 years. You have an amazing community here that has started only a few years ago and has grown. I wish that our economy were growing as fast. There are 2 things I'm going to talk about. I'm going to talk about the trading business. You're going to hear things here, new things that you've never heard before. I guarantee you that. And the second thing I'm going to do is I'm going to talk about market structure and some of the issues that I have with the way our regulators are doing things. And some of these issues are going to be controversial. And so I encourage you to disagree with my opinion. Ketchum, we're an open source shop. We have used R from the beginning, and we appreciate the contributions of a variety of people. And there are a number of packages that we use. I did go over this presentation yesterday with some of the members of the staff, and I have to confess they did take one of those packages off the screen. So we are going to keep very few secrets here, but that's one of them. Let's take a look at my first trading experience. 1971 to 1976. I had a full-time job, but I played 50 days a year in Tahoe and Las Vegas. I played 5 years. That'll end up to be 200,000 hands, roughly. I used a strategy. You can guess at this one. We actually use the Revere Advanced Point Count, which is slightly complicated, but anybody can really do this. Let's take a look at some of the numbers that you might have. For a long time, I played with a bank of around $10,000. I bet 25 to 200. It was, you can see that my advantage, .008, that's my lifetime batting average. 80 cents for every $100 bet. One of the problems with this game, there are a number of problems. One, the casinos don't encourage you to play, and they have a variety of countermeasures that have increased dynamically in the last 30 years. So it's difficult to play a game, but you still can get a game. So if I'm not successful in the financial end, you know where I'm going. But look at one of the problems. You know, you can't. It's not a guaranteed success. But look at if you go up for one weekend and you play 2 days, you got a 2/3 chance of being a winner. If you go up for 4 days, you got a 3/4 chance of being a winner. So if you combine with somebody else and you go up, two people go up with the same bank, same skills, you've taken tests to know that you're the same quality, you have a better chance of getting in the long run. If one person has $10,000, he can play 25 to 200. The other person can play 25 to 200. But if you combine your banks into $20,000, you can now play whatever, 50 to 400. So this is one of the motivations for teams in blackjack, and it's the same motivation we see in trading. I played in a team in 1976 that had as many as 20 players. We used a strategy very similar to the strategy that's used you see in the movie 21. But the means of communication and the strategy was exactly the same, but the means of communications were completely different. But you can see that the similar ideas occur at the same time. And I think the lesson there is go back and read the literature. And there was actually a book written about our stuff called The Big Player. Trading and blackjack have similarities. If you look at one thing in here, it just says, see, keep the faith. Keep the faith means that you got to know the pattern of returns that you're expecting. And if you keep getting that same pattern of returns, you haven't gone to a drawdown that is greater than the drawdown that you expected, keep the faith. And this is very difficult. But I did this for 5 years, the greatest learning experience. I'd be down, I'd lose half my bank. And oh my God, let's see, can I double my bet? I can get it all back. But I have to go the other way. I have to go opposite to the way my emotions are. So 5 years of training was extremely valuable to me. My second trading experience. I actually traded, I was an option player. I came from a theoretical value standpoint, so that based a lot of my future strategies were based upon theoretical values. Now the way I got my theoretical value was I took a look at the probability distribution of the stock price. I calculated the expected value. I subtracted off the dividends, and then I took the present value of that number. Well, it actually converges to the Black-Scholes formula. So that's the second time we've heard this lesson. Review the literature. Now, we had a variety of technological changes in the last 35 years. Can you believe that prior to 1985 that they wouldn't allow, the exchanges would not allow you to put a computer on the floor? I had several times in the Pacific Stock Exchange and the CBOE, I had staff members take my computer out. And can you believe that we couldn't even get a real-time data feed? So when we could stream prices for our options in 400 different series off of the the SPOO tick, that we couldn't connect our machine to the SPOO. We actually had to have a human ticker who ticked it up, ticked it down, occasionally go to sleep. Slight problem. That guy's name was Bob Kroll. He ended up to be a very successful trader. Technology changes in the exchanges. I find it interesting that the CME claims that Globex, I just heard a presentation down at Vanderbilt, and they said, really claiming that Globex really started electronic trading. Really, the United States is many times behind the times, and we were behind the times in electronic trading. It was the Germans and the DTB and Eurex that really pushed us to be competitive. I was on the CBOE board from 1988 to 1990, and they had a vote to see who the least popular member of that board was. I won because I said, you know, automate or lose, and they lost. Actually, I believe they still have the ICE has a greater percentage of the equity options volume. It's only their proprietary products that have kept them up in the rankings. Hull Trading Company had about 5 people, 1985. As I said to somebody else, we're really trying to follow along behind O'Connor and Associates. We had 250 people by 99, and then this little firm in New York that didn't know how to do this acquired us. They did something very smart. They took 2,000, they doubled the staff in the next 2 years. And then they took those people and took them all over the world. As Hank Paulson said once, he said he felt it was a DNA transfer. In 2000, I wrote an article for Futures Industry Magazine, and I knew that speed would be important, but I didn't know that in the next 10 years that I'd have to have direct market access to over 50 venues, that I'd have to know the individual order types that are as many as 20 on each of these, at each of these venues. I didn't know that. I thought price was the most important thing. That's not the most important thing. It's queue position. And I didn't realize that the SEC would create a regulation that made it more difficult to do business than easier. And I didn't know that intermarket sweep orders would be required. Now, Reg NMS is extremely complicated. Now, one of the things they say, you can't lock markets. You can't, if they're bidding 2 on exchange on NYSE, I can't bid 2 on ARCA because I'm locking the market. I actually have to either have to know that market that's gone, or I have to send an order there. Now, what this does is really means that you got to have tremendous connectivity and you got to have tremendous speed. Now let's take a look at what would happen to an institution that's trying to place an order on an exchange. Now think of the market as it's 1, 2. I've got 10,000 to buy. There are 1,000 offered on my exchange. I can buy those 1,000, but there's 2 offers someplace else, maybe in the Chicago Stock Exchange because they haven't moved their quote. I can't bid the 2, but the high-frequency trader he can. He sees my 2, and then he sees my 9,000 that was slid back from 2 to 1. He sees that big order and he says, well, I'm going to bid 2. So he can bid 2 before the institution can, and then the market goes back to the institution goes 2 bid. And so what happens is that the high-frequency trader, he gets queue position that he really didn't deserve. Now, there's some evidence that says, and I have some pretty good information that says that high-frequency trading profits increased significantly after Reg NMS. Now, at the same time, the high-frequency trading firms were, in fact, creating their own exchanges with their own rules. And BATS and Direct Edge. And these were supposed to be self-regulatory organizations, but they were actually for-profit. And they created rules, an environment that favored the owners. It's a little bit like the fox guarding the chicken pen. Now, one solution to this has been proposed by Manoj Narang at TradeWorks. He said, well, let's go ahead and lock markets. That's okay. He claims that, in fact, if you have a 2-cent wide spread, well, a 1-cent wide spread is better, and in fact, a 0 spread would even be better. Now, this is extremely complicated. I'm just now maybe getting a grasp of what's happening here. But I think it is conceivable that would be an improvement to the system. Now, there's going to be a book released shortly. And this book's going to talk about, there are 3 things I want you to know about this book. Number 1, it's going to talk about how the Chicago high-frequency trading firms took the game away from New York. It's going to talk about something called the zero plus tick, where the game is really to try to get queue position and then cancel after when you don't have an advantage, when there aren't many people behind you. This is very similar to what floor traders do. They'd see a big order for 2,000 and they'd buy 50 at 2,000 because they know they get rid of it at 2,000. So that's what the game is really played. It's played get Q position, and then when you lose your advantage, get rid of it. You either make a tick or you scratch. Something that's not well known is this book was delivered about 10 days ago to Carl Levin, the senator from Michigan, who held the hearings on the flash crash. And so I would expect to hear, I haven't seen the book yet. I'm begging to get one, but I haven't received it yet. So I would expect to see additional hearings about the issue of market structure. Now, this conclusion's a little bit premature that's going to go, so I'm going to skip right by that next slide. And okay, now what is really different about what I call modern high-frequency trading? High-frequency trading, I think there's something inherently different about what is happening in our marketplace than we think. It's not just one kind of technology that has come along. Because we have a technological advances, everything gets faster. But there is something different, and I think it is queue position. You know, if you get in front of the queue and then you cancel, and I think that is what the issue really is. Now I want to talk about the flash crash, and we'll talk about a number of things here that aren't on the slide. But imagine that you are, the flash crash has happened, you're Greg Berman at the CFTC, and they say, Greg, what happened? What caused this? Now we're going to give you a lot of resources to take care of this. We're going to get 20 people to go through this data. Think of what, and now you go about, well, I can find this. Well, let's go ahead. Okay, now about a month later, I haven't found it. What am I going to do? Well, they did find an order. They did find a Waddell Reed order for 75,000 contracts that started trading at 2:32 in the afternoon. And what the algorithm said is you can do 9% of the previous minute's volume. So they kept selling. They were selling futures, and they got down to a point of 241, and they actually sold, I don't know exact number, but 9% of 140,000 shares in this 3 minutes where the big precipitous decline occurred, which represents only, 10% would be 14,000 contracts, so a little less than 14,000 contracts in the precipitous decline. They only sold that small amount at that time. And what I contend happened is that HFT's ability to get Q position and cancel their orders has actually created an illusion of liquidity. So the investors are at a disadvantage here. They really don't know what's there. It's a little bit like catch me if you can. Now I think this behavior of HFTs is actually aided by the maker-taker pricing and the tiers. So the investor thinks he's got the liquidity, but he can't get it. Now I originally thought, when I said the flash crash, these things happen in a penny, I said, well, the investor was pretty stupid. He put these bids, he put these offers in. Well, why would he put an offer in if there was nothing bid? But they were bid there. They were just canceled all the way down. They were only canceled if, in fact, there was another bid someplace else that I could actually get out of it. And there weren't those bids. So it wasn't the investor's fault. As I thought, when I first read this, I said, it must be the investors. They're just stupid. Well, I don't think it's that. I think it's actually something bigger. My opinion, is supported by an academic paper, which, thank God I found something to support this. Richard Lindsay, I'm talking a week ago at the Vanderbilt conference that's been going on for about the 25th year, and I've gone to this conference occasionally. And I'm talking to Richard Lindsay, the past director of the SEC. And if you know him, he's an extremely competent, smart guy. And we're sitting there, and he's a regulator, so he takes things very seriously. And we talk about, well, what strategies add value? Could we really determine if strategies add value? And we said, well, I think we could. And so I tried to make some arguments that scalping strategies aren't as valuable as fair value strategies, and in fact, bringing liquidity from one market to another, those are better strategies. And if you created hot potato strategies, well, he said, but who would care? Who would really care whether a strategy added value? Craig Lewis, chief economist at the SEC, was also at that conference. I later talked to Hans Stoll, who is really the grandfather of market microstructure, and he said, what does that really matter? Well, what it matters, the reason it matters is that if we encourage the incorrect behavior, we will likely have a flash crash. If we incent people in a different way, we can prevent another flash crash. Now let's switch topics a little bit. Let's go on to tactical issues of trading. I envision this, the issue of speed. I imagine these 49ers, 1949 in the gold rush, all rushing to find the gold, and everybody else selling them picks and shovels. And then I envision Jim Barksdale of Netscape. He wasn't in the 1990s. And his son, actually, they came up with this idea. If we could do a line, a SpreadNet's line directly, and if we could con these 20 trading firms in Chicago to pay the same amount because the other guy's going to have it, and there was no cooperation between the trading firms, we'd really get them for about $360 million, and they did. They thought they could go on and use this for other things. I don't think it's been too effective. In fact, the real winners in this were the municipalities that were paid money to send the lines directly through rather than around the city. So I guess that's a lesson. Don't sign long contracts. 18 months later, those lines are significantly less valuable. And I find this mystery of who's putting up, as we went through this microwave thing about a while ago, it's been about 3 years, I think, since SpreadNet, so we're 18 months into this rush of, until microwave became a reality. And I find it a little bit like a detective story of trying to figure, you get this piece of information, that piece of information, well, they're doing this. And so these are a few of the things that I've gathered about what it costs. The current status is there are, in fact, I'm not exactly sure of this, but I'm guessing there are 4 firms that are actually using this line in some productive capacities. They're very unreliable and they go down all the time. But I contend, because there are multiple vendors selling their wares and trying to show you that they've got the fastest, the straightest network, then in fact these lines are going to be very cheap. And that really brings the issue of, is the playing field is it flatter now? Is it more difficult to be in this business, or is it allowing more people to get into it? Are we going to have a few large firms, or are the little guys going to have a better chance? And I think the jury's out on that. I'd like your opinion about that. Let's take a look at a couple paths. Here's the jagged path. Here's the straighter path. And some of the vendors have various, these can all come from the FCC website. And so you can actually see these paths directly. There's some interesting stories about what's happened, though. There's one firm that's got a real problem. They've got one connection they can't quite in, and they're in a significant amount of money. And then there's another firm that's got the perfect path, but somebody has a billboard right in the middle of the path. They got to negotiate with a guy to try to get his get him to take down his billboard. How much is speed worth? We tried to figure this out. We can't figure it out. But Manoj Narang, once again at TradeWorks, has a chart, and he thinks it's 1 to 3 mils a millisecond. 1 to 3 mils, that's a 1/100th to 3/100ths of a penny, and per millisecond. So if you did 100 million shares a day, that would end up to be $10,000 per day per millisecond. So if you could improve 3 milliseconds, it'd improve your profitability by 40, 50,000. Now I look at the trading business in some different kinds of ways. And one of the ways I look at it is through the moments of distribution. Everybody's a statistician, so we've got the mean, the standard deviation, the skew, and the kurtosis. So I actually have, I've tried to put this all into one organization, one algorithm, and I can't figure out how to do it. So I've actually split it up into 4 different components. So I have actually strategy going in all 4 of those areas. Once again, I said before I said we're a fair value trader. We create an expectation of the instrument. We risk adjust it, and then we decide how much money do we want to make, and we put a bid and an offer around it, and we do it over and over and over again. I look at the business as being in 4 quadrants. I look at futures, securities, options on futures and options on securities. The direct paths that I see of information flowing are between futures and securities, and then obviously between the futures and the options, securities and the options. So I really look at this as 4 different possible connections, and they're each 2 ways, so there are 8 possible connections of information. I look at the real ultimate players are information flow going across asset classes and geographies. And so I'm currently working in 3 of those possible 8 information paths. Of course, if you had 8 and 4 different continents, you'd have 8 times 8 times 8 times 8. And, but it's very difficult to implement these strategies, especially with all the rules that have come up. And so we have, one of the things is, this would be the cost of, I think, the minimal cost of being in the trading business. The question is, if you're really small and you're just starting out, how can you survive? How can you make it in this business? Well, one way is through coopetition. Now, this is actually an old word. It's been around about 50 years, but it was actually used in Silicon Valley with Microsoft and Intel. But what we do is we coordinate with our competitors on the things that make sense, such as reducing clearing costs, getting to higher tiers, actually learning about agreeing to exchange information about how the exchanges work, saying, okay, that's not going to be our competitive edge. And then the question is, do you actually keep, in that kind of a model, do you actually keep your secret sauce? Well, most traders, and they won't talk about their secret sauce. Well, I contend that secret sauce is highly overvalued, and that their ideas are a dime a dozen. Execution, now that's the problem. So, but my conclusion is that if you shouldn't share if you're making over $100 million. So I'm here. I guess that means I'm not making $100 million. We'll talk about catch-em trading in a little bit. We got two businesses. We have a core business and a core group of 13 guys that are fabulous. And somebody said last night that our staff was going to be empty. Well, I guess all of our players are here, so I didn't know that. I didn't get permission to you guys to come. No, I'm glad they're here. So we also believe in this coopetition. So we invite other groups to come in, and we have 4 different groups that are currently active traders, and we got two that are struggling, one that's actually making some money, and one that is kicking our butt. So it's great to have people come in and show you that it really can be done, and we're chasing them. We're trying to catch up with them. But we provide technology infrastructure. We're co-load. We didn't bite on the $300,000 a month and the SpreadNet lines. We're hoping to be in test on a 9 millisecond line shortly. And we love to share ideas. The requirements for us to agree to support a group is that we really do like to know that these things are profitable. We don't have a lot of patience. So we like Sharpe. Everybody says Sharpe ratio over 2, love it. We like Sharpe ratios a little bit better than that. Our Sharpe ratio runs something 15, 16. We actually want that to be lower. But we do like strategies that are statistically significant. Now, I'd expect that this team would have advanced degrees. And one requirement that I forgot to put down here is you have to use R. So my conclusions about the trading business are that it is an extremely difficult business. And my conclusions about our regulatory situation is that we are I believe we got a structure that's got a basic problem. And that the '87 crash is very similar to the flash crash. It was an illusion of liquidity. I had a party at my house in California 2 weeks after the '87 crash. And Mark Rubenstein was at that party. And I remember him saying, he was a very serious guy. He says, I caused this. I really did. I caused this. And he didn't really cause it, but investors thought that they could buy portfolio insurance. And the assumption in his model was, I can sell futures anytime I want. So in '87, we had an illusion of liquidity. And if we look at what happened in the flash crash, the same thing happened. We had an illusion of liquidity. So I think we have to remove that illusion of liquidity, and that's a function of changing the market structure. Thanks for your time. Does game theory have anything to do, is there a game theory strategy that would help in queuing? I have not personally experimented with any strategy in game theory. I have come from pretty much a statistical standpoint. There are firms that are based on poker. Our firm is really not based on those kinds of strategies, but it's a logical extension, and I would agree that you should have that in. I don't have it. I sort of go with the game the hand that I'm given right now. I would hope that we'll see more interest. I hope we'll see a fairer playing field. I hope that investors will say, hey, I've got an even shot here. I think that we are still in if I were to completely speculate, this isn't my business, but I would say we're going to see a downward trend in volume before we see advancing. And that brings up another sort of interesting issue. Trading firms are going in through flux and are consolidating and trying to do what they can to reduce costs in these times when profitability has been lower. Well, certainly if investors are more knowledgeable and that when they put in orders they're more careful, what you said, it's the perception of liquidity.
What should change is the perception of guaranteed.
Yeah. So the investor has to really know, he should understand what he's going to get. And you don't believe these bids. You can't get them. I'm thinking this is, I may be agreeing with you here. I think that's a good point. Okay. I had an option, I had information going from the securities to the options. I had one line there. The lines go both ways. There is information that comes from the options to the securities. We have done some statistical analysis on that. I've done that 7 times, 7 different studies. I can't get anything that's practical coming back, an algorithm that gives me information from the options, and I would love for you to tell me what the algorithm is that gives me the information from options going back to securities in a succinct way that I can code. And I want to see you right afterwards. Well, there's a scarce resource in technology. So anytime you do send a cancel, it's got a cost to it. I've always thought that exchanges should charge. And I think that the exchanges, just following political pressure, have gone to those kinds of strategies. They haven't affected our strategies yet. Oh no, actually the Merck on the E-mini, on the cancel ratio of 3 to 1, does affect some of our strategies. It does. That's the single one that affects us. And I think that going in that direction, anything that will get a sense of, so that the investor can get a sense of true liquidity, anything that goes in that direction, and penalizing by cancels is one thing that would go in that direction. I don't claim to have the perfect market structure. It's very complicated, but I think you going in that direction is smart for the exchanges, and it's one of many options we have. Well, you have some sense of whether they have an edge. Somebody's got to have, in any game you play, whether it's blackjack or tiddlywinks or poker, you've got to know that you have an advantage. So we have to have some sense that you really have a game that you can win at. Then, as you start, there are all these unknowns about technology, and we do look carefully at try to measure the pattern of returns, and then we try to use standard statistical techniques that would help us determine that you don't have an edge. And to be honest, that final number is, if your Sharpe ratio is south of 3, you're gone. So yeah, and some people have been in that business. They haven't even gotten to that point, and I've said, get a real job. And these are friends of mine. I said, I can't help you. You can't. This isn't going to work. I'm sorry, it's not going to work. And at least in my opinion. And they're still trying, and I help them out if I can. But so some strategies. It's very difficult to get a strategy that works, and I hope that all of you have strategies that'll work. It's been a real honor to be with you. Thanks for your time.